The broadcast is now starting. All attendees are in listen-only mode.
Hi traders, welcome to the live webinar with Admiral Markets. My name is Chris and we will be focusing in this live webinar on exiting trades rather than entries. Of course, a lot of attention and focus is placed on entering setups, finding strategies, finding entry methods, and trying to get into the trade. Less attention is given to how to exit, in fact, and that is equally important, maybe even more important. Why? Because basically, obviously, exits are the key factor in what result you get. I know entries is the starting spot, but depending on your management of the trade, you could have a bad starting spot, but if you manage it decently, you could get out at a good spot. If you have a great entry spot, but you don't manage it properly, you might have actually even worse exit, and that's really very important. So I would even argue that exiting is perhaps even more important. In any case, it's definitely something you want to pay attention to. So that's what we're going to do in this live webinar. First of all, though, we have two disclaimers to discuss. The first one explains the fact that this live webinar is shown to a global audience and the recording as well, but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity to find out if this webinar is suitable for you. And second of all, please note that trading for exchange and global financial markets in general is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, so I'm going to keep it pretty simple. I just have one slide prepared for you. That's it. And otherwise, I want to show you charts, live charts, and we can take a look at the MetaTrader platform from Admiral Markets in just a second. And basically, what this slide shows you is on the left, key factors for the exit when prices, when you exit basically with a stop loss. On the right, when you're looking at taking profit. So let's start with the left. Basically, when we're managing and exiting, we're always focusing on cutting losses short and letting winners run. Now, that does not necessarily mean taking profit when we have 2 pips profit. That does also not mean cutting losses short does not mean exiting the trade 1 minute after you've entered. It might, but definitely most likely not, right? That's very, very short. And often these things happen due to our trading psychology, due to things that go through our mind when we look at the chart. We feel fear of all kind of things, right? Missing the trade, fear of retracement, fear of losing the trade, fear of missing the target, fear of price hitting our stop loss, fear of price going against us, you name it. All of these things. We have, it's an emotional battle in a way. And it's for us the task and kind of the goal to manage that, not remove it, but manage it. So whether that requires us to sit literally on our hands so we cannot touch any buttons, or whether that is to stand up so we physically remove ourselves from the computer, whatever it is, we need to find a way so that we implement, an exit strategy that is beneficial in the long term, not only for one trade, but for a series of trades, like 40 to 50 is often kind of the minimum you want to analyze and evaluate before you see if you have what kind of performance you can expect or can make from that strategy. Anything less is too little to really to make any judgment. One trade doesn't say anything. One loss, one win, it's nothing. So let's talk a bit about cutting losses short. We know what it's not, so let's talk about what it is. And not many, just very quickly, not many traders talk about this. They often talk about cutting losses short, letting winners run. I don't hear about practical ways how to do it. I want to do that in this webinar. So, okay, first of all, the starting spot, we need a stop loss. And if you're trading with leverage, at least. I mean, if you're trading without leverage and you're just taking 1,000 euros of your own money and you exchange it for the other currency, well, you don't need a stop loss necessarily. That's more long-term trading, obviously. Most of us, all of us, probably are trading with leverage. You need a stop loss, otherwise you're risking your entire trading capital. And it's not that scary, I think, if you know how to place a good stop loss. So this is important for risk management. We need to find a good spot, a technical spot, an invalidation spot. I use fractals. I'll show you on the chart how I do that. I also use for basically finding the better spot of a stop loss. I use moving averages, pivot points to find more confluence of support or resistance. So I hide the stop loss there. Now, this is not earth shocking, right? This is not how do you say? This is not rocket science, right? You've probably heard of this before. This is, not this is common. It's all about implementing this in practice and finding, of course, the entry that makes sense, and then finding the stop loss at that spot that is a decent stop loss. That means not too close, not too far. And I can give you tips here, but it's really all about practical implementation. So we're going to be taking a look at the charts in just a second. Then using trail stop loss. I know that not everyone is a fan of trailing, of using tightening trade like that. And I have to admit that it is a fine balance. You don't want to do it too soon, not too late. However, I do like it in general because not the very beginning. I want to give time to the space. As I also mentioned here on the left, you want to have, when you do trade management, you want to have a combination of patience, but then tightening the trade, the trail at the right time. And that requires a little bit of feeling. I do discuss in a trade management webinar we've had with Admiral Markets before how I give patience at the start, then move to break even, then patience again, and then try to lock in profit. So it's this up down kind of cycle in a way. Up down, tight, loose, tight. Loose, tight, loose, tight. Um, but I do use trails eventually in Fractals because I want to use that new information that is available as the chart, as price develops. We get new information. We can use that to see if the trade is still good, if it still looks acceptable, and whether it makes sense to stay and at what spot. And if you don't use that info, you're trading set and forget. And I think that it could work out okay. But I think that if you practice an active trade management style, it is in the long run, if you do it properly, better. It is more challenging though. So then we can take a look at letting the winners run. That is basically finding a spot on the chart where we expect price to make an impulsive move, or we expect price to make a corrective move, and we're trading a range. So it's a lot about understanding the impulse and correction. Then if there is an impulse, using Fibonacci, retracement, targets, sequence levels for exits, knowing when price might be bouncing at a target and taking a market exit, taking the profit at the right time, not waiting too long with that. When we see price going our way, looking for patterns in general, looking for candlestick reactions, divergence patterns, to try to find a target that is doable and we feel comfortable with without giving up too much profit. All right. It's a fine balance. We're going to be talking about that now with some live examples. So let's go to the charts now. And we can talk about some examples today, perhaps, of some movements, market movements that I was thinking about. Now, I was a bit cautious today, so I didn't trade, or we can talk about some setups I did trade earlier this week. Today, I did skip some setups that I was thinking about. They did work out well. I was a bit cautious because of the fact that I thought that certain currency pairs were overextended. A little bit hesitant with that. I can show you some trades I did take earlier this week. And if you want to take a look at something in particular, of course, you can reach out through the chat and let me know. Um, Sorry about that. I just noticed that you were not seeing my screen, actually. Sorry for that. My mistake. I didn't realize it was frozen. I was showing you this slide, actually. There we go. All right, so left, cutting losses short. On the right, letting winners run. All right, but we'll go through that with the live charts. So technical stop loss placement, using trail stop losses and fractals, patience, and tight management. It's a mixture of that. And then using fibs, candles, and patterns, basically for finding the best targets. This is what I was showing. I'm really sorry for that it was frozen. I also was showing these two disclaimers then. I would have to go through that just to show you these disclaimers then. This is the first one. Here you can find a link. And here find the risk disclaimer as well. Just please pause this video then when you're looking at the recording. All right, so we'll move on. I totally forgot that the screen was frozen at the beginning. All right. There we go. So euro dollar today. I wasn't really trading it today. I knew that there was a chance it could break to the upside. I wasn't looking to trade the euro dollar. I knew that it could break to the upside. Didn't think that. I thought it could break. I didn't want to trade that though. This was one I was going to skip because I thought it looked a bit that it was running out of steam. It was losing steam. The upside looked good. I was bullish on the euro dollar the whole week, but at this point, I thought that the upside could happen. I didn't like, the odds of that setup. I thought it could go up for 50 pips. I wouldn't trade it if it did break. It didn't break actually. So the fact that my analysis was showing that it was running out of steam proved to be correct. In fact, kind of like one could say head and shoulders like this. So anyone who was taking longs, I did take a long on the euro dollar. No, I didn't. Sorry, but I actually did give my 2 cents to some traders actually, and I said that this could be a good long. I didn't take it myself, but they wanted my opinion. All right, and that did work out pretty well. So anyone who was, for instance, as an example, in that trade, right? I took other trades. I didn't take this one. You don't want to take everything and anything. You want to select the trades that make sense. So, but if you take that one, you want to have patience with it at the beginning. You see a flag like this, stay in that trade, right? And try to manage it in a way that you can get more mileage out of it. So, and you see a break, pull back, continue. This is where you can start moving and using the trail stop loss to lock in some profit. And whether you do below this bottom or whether you go below this bottom, but that's about it. I wouldn't give more space to this upside because you can see a clear triangle here. And if price breaks that triangle to the upside, great, you get more pips. But if it breaks that triangle to the downside, you don't want to stay in because this could basically reverse and it could start a new swing to the downside. So if I would be trading, for instance, this break to the upside on the euro dollar, I would be patient with this part because you're getting a higher high, you're getting a flag. I would even be patient with this part because you're getting another continuation. And I think looking at the bigger kind of analysis that a push to 124, 125 zone is possible. But when you see price action candles like this, a lot of wicks, of course, don't forget that this is, higher high number 3 or 4, diversion starts to kick in. That's when you want to trail stop. You want to be tighter with your trail stop loss and lock in that profit. So this is basically what I'm talking about when I'm talking about this patience and tighter management and using a trail stop loss and fractals for that. Now you don't see the fractals here, but we can add it very quickly. go to indicators, Bill Williams, Fractals, and you can see those levels. And that's why I said you can use these fractals or you can use this one, right? This group of fractals. Depends on how tight you want to use that trail. But as you can see, most of these fractals, right, kind of have a nice sequence of higher highs, higher lows. Not always, you do get a break here and there, but roughly. So that would be a tight one. This would be a bit looser trail stop loss example. Now, if you take this setup as an example, where would you put the stop loss? I would go probably either below this bottom, or if you want to use a tighter stop loss, below these two fractals, right? Those are decent spots. I mean, this one is the key invalidation spot. This one is basically okay as well because there are two, at least, no, there's one fractal actually when the entry was done. But you know, it's a bull flag, and if it breaks below that level, then it's probably not a bull flag. So both are valid technical stop loss spots at that point, and you can use moving averages and pivot points, right, to make an assessment about that. And you see that price is breaking above the weekly pivot point with this candle. So I think it makes sense to use these two fractals. It's okay. And if you have a moving average, well, we have the middle of the Keltner. That is like a 21, 20 EMA. And you can see that price is using it as support. So here again, fractals at that middle of the Keltner channel makes sense. And this is the Admiral Keltner, by the way, which is part of the MT4 and MT5 Supreme Edition. SE is the abbreviation plugin. And this plugin is specially developed by Admiral Markets, has dozens of extra features, 60 and more. One of those is this Keltner channel. Definitely try it out, and you can just download that for free. Very useful, and you can see immediately with the Keltner middle band here or the extremes where technical stop losses could be. So we went through an example about where is a good stop loss, how to use trills, and when to apply loose and tighter trade management. With regard to the target side of things on the euro dollar example, well, what I like to do is use fibs. So what I would do in this case is put a fib from here to here, the retracement. We can see that 61.8 and 78.6 fibs at 123.75 and 124.20, and the R2, which is the Admiral Market pivot point indicator. This is the weekly pivot point. You know, those are good levels to aim for it, and it indeed bounced at the 61.8 fib. Other things, of course, we can do, what I like to do is fib target. So we would get, let's take a look and flip it around. This is a fib retracement. So we can take a look at targets. Let's go back to the hourly chart, and we can put a fib, for instance, from here to here. There we go. And we would be looking for perhaps an exit at the minus 61.8. That's an earlier exit, but if it extends, we can look at minus 100, minus 161.8. It missed that last one by a bit, but you can see the potential there. Last but not least, I like to use Fibonacci sequence levels, and that's just using sequence levels in terms of pips. So with an hourly chart, with the euro dollar, I like to aim, let's see, at about 233 and 377 pips from the bottom. So 122.14 is the bottom. So plus 20 plus 144 is about 123.60, which is about here. And 124.40, 124.50. Right. So anywhere between these zones, these purple lines is kind of the main target zone for the euro dollar. That's also based on fib sequence. That's the fib sequence levels from the very bottom here. And you can see the price went into that zone, struggled, and fell back. So I mean, would you take profit in here? Maybe, I don't know. It's something that wouldn't be that strange of an idea. It depends how aggressive you want to handle it, whether you go for the trill or if you just take profit in that zone or not. All right, that I think depends from case to case. Today on intraday time frames, I was looking for pound yen, for instance. Now, ultimately, I didn't trade it, but and one of the reasons was because it was quite an extension from, let me see, from this bottom. Oh, sorry. And yeah, I knew that there could be one more move up. I didn't like it in the morning because I knew also that there could be a retracement, a deeper retracement. It was in this triangle, and I knew that it could make a retracement first and then move up. And if it did move up again, that breakout could be interesting. Um, it's just that the position was quite. There could be one more push up. It was just that if price has moved up that much, it was a little bit overstretched. It was a little bit extended, and hesitated still with entering that kind of late in the game within this upside. But it did work out, and the breakout candle was here, as you can see. But actually, my entry was here on this one, actually. My entry system said this was the entry, but I mean, this is not about entries, it's about exits. So for me, the stop loss would have been here, this below this fractal. That's pretty simple. There's a moving average, there's a Keltner channel. So that's for me, the technical stop loss right there. So the stop loss size between the entry and the exit is about 48 pips. And the exit, I had a fib target zone at 152.50. So I would probably seriously think about it to take profit there. With an entry at around 151.60, it would be about 90 pips. It's about a 2-to-1 trade in terms of reward to risk. And if I went for the trail, I would be using these fractals. And if I would be in this zone, I would probably even move to a 5-minute chart and use the fractals there on the 5-minute chart. And be looking for maybe some either fractals, or if I see some candlestick patterns that are weak on the 50-minute chart here, I would go for a market exit perhaps, right? And at this moment, if I would not have taken profit at 152.50, I would probably put the stop loss at 152.55, and if not 152.65. And I would probably aim for one more higher high. I put a TP there, maybe at 152.98 or something like that. If I wouldn't. I'm not sure which tactic I would choose. Whether I take the TP at 152. I don't take TPs that often. I typically like to let price move. Then I use a trail, or then I add a TP, or I take a market exit, for instance. Typically, it's a trail, and perhaps later adding a TP. And the reason is that you can see how the price action works, how the price action moves, and then you can decide later on if you want to add the TP or not. The advantage is that if you exit at 1,250.50, you got good profit, you get a 2-to-1 trade, great. But now it continued, and you have a chance to maybe even aim the TP at 153.38, for instance, right? At the minus 100 target, it's quite far, but it's possible. The advantage of a TP, though, is that if it hits 152.50 and it turns and you use a trail, you would get maybe not 90 pips, but you could get 60 or 50 rather than 90, right? Obviously, you have always that flip side. So what I do to gauge whether I want to take a TP or trail, it really depends on how strong is the TP. Is there a lot of confluence? What kind of support and resistance levels are there? How strong is the trend? Is there a divergence? It's a mixture of that, really, and I make a discretionary call on that. So, I've been talking about potential setups here, but let's talk about one maybe that I really took. That was, let's see, I have to, yesterday, I'm thinking which, Let's see, was that the euro dollar yesterday? Let me think here for a second. Oh, hang on, folks. I lost my screen. Let me bring it back. If you have any questions, or if you want to take a look at a particular setup of this week, let me know, and we can take a look at that. I am opening, just 2 seconds, it'll be open in no time. I'm opening up the MT4 and MT5 as a backup. All right, 1 second. Just let me know if you want to take a look at a particular setup and how, give me a currency pair, or give me a or other instrument, DAX, gold, of course, CFD, fine too. Give me the entry, and let's take a look together at the exit. All right. Sorry, I just need to change the profile because it rebooted, so it goes back to the default profile. But I just need to change that. There we go. In the meantime, we can take a look at the MT5 platform. So let's take a look at, there we go, market watch. Let's take a look. I think it was the euro dollar. Let me check. Yesterday. There we go. Let me scroll back here. Yes, took a trade on the euro dollar indeed yesterday. No, that was 2 days ago. It doesn't matter. That was Tuesday. And took this breakout candle right here. That was the entry. And the reason was because of what I said already earlier. I didn't take this euro dollar long, right? Although I did talk to a few traders and said that I thought that could be a good trade. I preferred others at that moment. But when I saw the continuation, another bull flag, I thought that the one, continuation at that point was likely. So I did take this one then later on the 50-minute chart. That was the entry. And so I put the stop loss below the low here. I thought that the stop loss made sense because of the breakout and the system strategy that I was using, the entry strategy, the entry method. I thought that stop loss made sense. I went below the previous fractal around here. And with some consolidation, I was patient with that consolidation. It was going up and down, and that's fine. I just waited for that. I did move a trail below these fractals and these lows. So I moved eventually this trail like this, the stop loss like that, and reduced the risk, as you can see. Right? But in the meantime, I didn't exit. I didn't panic. It was a consolidation. And it didn't worry me necessarily. I knew that there was a breakout. The trend is up. This could be a price pattern, a chart pattern that could be in my favor, and the price could break the upside. Right? So not a big deal really. I did move the trail to reduce the risk. And I think that many traders might, not many, but I don't know, some traders might get worried about this. If you don't know what impulse and correction is, you see price moving fast and then you see it go flat for a few hours, and that discourages traders. They exit and then they see price move their way, right? They see this, they think, oh, I missed the trade. They enter here, up in here, late. And then they see again price go against them. Just an example how the psychology could play tricks on your mind, and you can enter at the pretty good spot, but then exit at a bad spot, enter at an even worse spot, exit at even a worse spot, and just get into this spiral of doom, as Nennet often calls it. So I remain patient. I know that at the start of the trade, time is on my side, not forever, right? Eventually, I do want to move and be more demanding, and I want to see the trade move my way. And when I saw the break to the upside, that's what happened. And because it was a 50-minute setup, I did move the trail a little bit more aggressively with this break because it was already the second break, and I think I moved it up at around here. I moved the trail stop loss, and I moved the tighter stop loss. Let's take a look at the 5-minute world. I think I used this 5-minute fractal here. So I went like this, and it hit me, made the ABC back down, eventually went up again, but that was the next day. So it was not a spectacular win. It was 40 or so pips. I guess, roughly plus minus, and the stop loss was about, hang on, 30-ish, I guess, but not bad. And that was an example of one trade I managed. Regarding the target, I didn't have any TP at that time. I was trail stopping it, but I think that I was anyhow aiming for roughly, into that 124, 125, 124.50 zone in my mind at least. I didn't have any TP yet. Yes. So fractals, basically, good question. So I use them as for stop loss. I use them for trail stop losses. So here you can see the fractals. I have my own fractal, but it doesn't really matter. My own fractal is just using some kind of extra information about the trend and stuff like that. But key thing is, where are those fractals? And that's what this fractal indicator shows. And you can see that basically, when you have an entry, you're looking for a stop loss placement. So what I do is I go below this fractal, for instance. Now, it depends on the entry strategy. It depends on your entry method, and it depends on your strategy itself. I don't know what your style of trading is, and maybe the way you enter fractals are not so useful. I don't know. I know that if you're trading more reversals, fractals will be not as useful. They could still be useful. Let's say that you trade this reversal candle here. This fractal that you see at the bottom would not be visible at that time of the candle as it prints, because the fractal is only valid 2 candles after it closes, 2 candles after this candle, because the fractal has 2 candles to the left and two candles to the right that are lower or higher above the low of the middle candle. So you wouldn't see that fractal then. It wouldn't be valid. There would be nothing. So where would you put the stop loss if you take a reversal candle like that? Well, the fractal is all the way down here, so that's less useful. So you would maybe think about candle lows or candle highs or round levels. It's not always useful, but if you take this breakout, like I did, then this fractal is a good info. I mean, if you can use 2 fractals, even better. The previous fractal is okay. It's 2 fractals is stronger, or you could use a fractal of a higher time frame, and use that. I mean, in this case, obviously the stop loss is further away. We have to go all the way to this bottom here, which is about 60 pips away. So you could do that. It's less risky. Why is it less risky? Because there's plenty of time to trail stop loss below this bottom probably, and reduce the risk by a lot. So you're risking a little bit more. Your leverage is less. Your lot size might be smaller, but if you lose, it's going to be a small loss because you can quickly trail. You could use a very tight stop loss, and many traders try to use a tight stop loss because they want to take as big as a lot size as possible. and maximize their reward to risk so that they, I don't know, have a 20 pip stop loss and they try to gain 60 pips, and great, you got a 3-2-1 trade. But there's a chance that there's a good chance you're going to hit the stop loss probably. If you use a little bit wider stop loss, you can trail stop loss it and you lose less. So it's a balance. I try to get a stop loss on a 50-minute chart that is not like 5, 10 pips. It's typically too small, in my view, if you're trading how I trade at least, which is often like not extreme reversals, or any reverse, or yeah. Well, sometimes I trade reversals, but yeah. So not like level reversals. So, but anything between 20, 30, 40, wherever the fractal is, 50 even, makes sense. And I still managed to get in about 30% of the cases a trade that is giving me 1-to-1 or more as a win, and on a 50-minute chart, and about half of those, maybe 15% of them go for bigger wins, like 2, 3, 4, sometimes even more, 5, sometimes even 6-to-1. I mean, those are not regular, but those are not like every day, but sometimes you get them. Really big pushes. If the stop loss is 30 pips, and you sometimes get the 180 push, it could happen on the pound yen, for instance. So I would use fractal and then try to trail stop these fractals at the right times. Not always. I try to look where the fractal is in relationship to the moving average and whether I use that fractal or not. For instance, these fractals are away from the moving average, so they're less sturdy. These are at Keltner bottom, they're sturdy. So it depends. Also, has the trade just started? Be more patient. Has the trade developed longer? We could use a tighter trail stop loss on this time frame or even a lower time frame. And no, MJ, unfortunately not. Don't know about that particular currency pair. But I wish you a very good holiday or trip. Travel sounds very good. So that's about it. Some practical tips. I didn't want to make it too theoretical because I think anyhow these concepts are very useful, but it's a matter of practical implementation. During trading to get that experience to know what to do when. That is really, really the most valuable. But I think, in my view, these are the most important tools and methods that I use. So basically, Fibonacci, retracement, targets, sequence levels, candlestick patterns, chart patterns, Admiral Keltner, Admiral pivot points, fractals, and moving averages. I think that wraps it about up. Yes. So it depends, of course, on your entry, your method as well, how you handle that. I'm just sharing my 2 cents about that, but hope that helps in some way for your trading. We'll be back with more webinars tomorrow. I think one more daily trading idea webinar in the morning, and we'll be back next week with more webinars at Admiral Markets. Of course, you can find out more useful info at admiralmarkets.com. Check out the MetaTrader Supreme Edition, for instance, and get those extra features and indicators. And wish you all great trading. Cheers.